Jill, good morning.
Hi, great to be back.
Yeah, good to speak with you. Looking back, crypto really, we have no history or no good history of how the market might respond to a full Fed tightening cycle, if in fact that's a major influence, right? 2015, late 2015, the last one kicked off. Bitcoin was, a few $100. It was a different game. Do you actually think that's a key influence on crypto these days?
Oh, absolutely. I mean, crypto remains, as with so many other asset classes, broadly influenced by the macro. And as we look at this hiking cycle, one of the big questions is crypto and Bitcoin specifically going to trade in line with gold as an inflation hedge, which of course has been a long-held thesis around it, or is it going to trade in line with risk? Of course, so far, we've seen it trade in line with risk. Personally, my view is that we're going to see that continue and persist. I think that the market is not yet at a place of maturity to start to decouple crypto assets within the asset class itself and to view Bitcoin separately as the inflation hedge.
So if it is now behaving largely as a risk asset, same, maybe similar pool of the investor base as is driving some other things like the NASDAQ and other tech stocks, do you think that means that there's more downside shakeouts to come, or are we just going to have to track the NASDAQ?
Yeah, well, look, obviously we've seen risk broadly react positively to Powell's comments this week, looking at a very measured approach relative to what he could have said, of course, when it comes to the tightening cycle here. And I think that that's important to note, that short-term reaction. But I do think that longer term, the risk is to the downside. You look at the last sort of mini hiking cycle that we saw over the course of 2017 to 2019. Of course, during that period, we saw Bitcoin breach the all-time highs at the time of 20K, and then we saw a very prolonged period where Bitcoin traded down around $3,000 in price. Mm-hmm. And that was a very painful capitulation for the market. I don't think we've seen anything like that yet on the crypto side.
No, certainly not. And just in terms of the regulatory influences, of course, we've all digested the Biden administration's executive order of last week. UBS actually out with a note this morning trying to suggest that executive order maybe was a little bit less friendly to the industry than it had been initially taken, pointing out that of the 7 bullet points, the first 3 are about participant protection, mitigating risk, illicit activity, things like that. What's been your take on what that's going to mean down the road for potential restrictions in this area?
Look, all regulatory clarity is good for the industry right now. For too long, the industry has had to operate in this sort of shadowy area where it's not quite clear who the regulatory bodies are, what enforcement action is going to be taken with regards to what projects, whether that's going to be, enforcement and regulation by FinCEN on the fears of illicit finance in the SEC. But what's important to remember is that crypto has all along been regulated. None of this is particularly new. What's being offered by that executive order is above all going to be clarity. And I think that's a very good thing for the market. Similarly, when it comes to consumer protection, if you look back at the history of any new technologies, whether it's railroads, whether it's the IPO boom 2 decades ago, you've always had fraudsters, scammers, grifters coming into those markets. And crypto is no different, and consumer protection is a very important thing. And so I view all of that as a positive, sort of for society at large, but also, frankly, for the good actors in the industry who have had to make their way through all of this noise over the last decade that the industry has existed.
Yeah. So some rules that everybody knows probably would be a good thing. Jill, thanks very much.
Thank you.
Shepard Smith here. Thanks for watching CNBC on YouTube.